Welcome back to another video. Today I would like to share with you how you can trade with fundamental data and how to make sense of the complex financial markets using the sentiment data in correlation to the seasonality data. It's one of the most important parts in swing trading to understand that technicals won't bring you that far, and that you do need extra context to have a solid strategy in place. You won't win over thousands of trades, you will just win over quality trades. And today I would like to show you how I'm going to do that. So I will start with forex. Forex is one of the most, or it's the most liquid market in the world. And the most important thing, the most important tool that you have here is the COT report data. This is the actual positioning of the biggest market participants that you can see right here. You can add this information yourself to the chart via the indicator tab, and then you can just type in here COT. And as soon as you type in COT, just a second, COT, you will get a lot of different tools, and you can choose one of them and then just focus on the commercial positioning. So the people that actually move the market have to open their positions to the CFTC. This is a regulator that regulates all the transparency in the market and makes it like a fair process, so to speak. And as you can see, first of all, at the first glance, you just see that there is always a discrepancy between the actual price. So price is rising. You can see that right here, price is rising, but COT data is falling down. Okay, so some people might think, so what is the actual value of COT? It's like the reverse engineered. So how can I trade with it? And the thing that you have to do is you have to understand, okay, and this is very important, that this data is a hedging type of data. It's not playing out tomorrow. It's not a tool to integrate in a process of like immediate action. It's a tool that shows you what is the overall positioning for a longer time frame, and it shows you that these people are hedging against the price trend and engineer the next price leg. So let me give you an example. You can see this clear downside trend that was right there. I will show this with a channel, a regression trend channel like that. You can see this trend here. And now if you look at the same data in the COT part of things, so let's take a look at the COT data right there. You can see what just happens in this sector. So price is declining significantly. This was 2020. Now in the COT data, there's a bit of a difference than in the price chart. And you can see primarily the institutions are buying this sell trend. And this means they are hedging the positions. Okay, they are already engineering the next trend. And as soon as this behavior switches, which you can see right here, you can see here that we change the bias a bit. So the trend is actually right there. That we have a double bottom, so to speak, in the technical terms. And there you can see the data is switched up, right? You can see a clear drop in the COT data, which then indicates a trend reversal. So you have to think a bit out of the box. If those people are hedging and engineer the next price leg in a short trend, so a bullish trend, then you know there is certainty that you will get another bull trend. And you can see this right here. The trend is always bullish hedging. And here you can see a shift in this behavior. So you study and analyze the COT behavior for market sentiment in the future. Now here you see this shift. After that shift, you can see price follows along. And now take a look at what happens. This is very, very, very crucial to understand. Now, if you take a look at this bullish trend, what can you see in the COT data in this trend? And I think now you will understand this far better than before. You can see that after we swapped here and we stopped buying, the commercial stopped buying, the longs are playing out right now. And then we are immediately starting to hedge bearish to then engineer the next short price leg. So this is like future data. It plays out in the future. Okay, it is playing out exactly in the future. The only way you can trade like with the positioning itself is in a consolidation. This is the only way to use this data as a timing tool. But you don't have to focus on that. Just focus on the sentiment, the core value of this tool. And this means you can see in the future what is going to happen. And there is nothing anybody can say about that. It is the truth and it will happen. It happened all the time in the past. And this is just how this market works. And you have to understand that you can't time it. You can do nothing about it. But if you see a crucial point like that, you can say 220 right with this break. You could have said, okay, they stopped the bullish hedging and now the bull trend will follow. Now, the exact same thing happens right here. You can see they stop selling. Here were their peak selling. So this just means they're maxed out bearish. And then they start to stop being bearish. And as soon as they stop being bearish from here on this point forward, price switches to the sell trend. Okay, and this is how the CUT data is inside of a trend. But now we always have times where the market is more choppy or building out more consolidations, and you do have an opportunity to capitalize on that as well. And you do need another perspective on how to use the CUT data in a consolidative price behavior. You can see that right here. We had a very long sidewide phase in the DXY, and you can see this also in the data. Now, here, if you have a consolidation, you do not look for a hedging behavior, so to speak. You can use this as a exact timing tool. So, what can you see as soon as the market makers are very bullish? The market goes up. What can you see as soon as the market makers are bearish? The chart goes down, and so on and so forth. You can see this also right here. They are bullish, it goes up. They are bearish, it goes down, and they are bullish one more time, and then it goes up. And then as soon as we close out of this consolidation and start to break out, to go into another trendy direction, the market seems to not any longer follow this consolidation rules. Okay, so this is very important for you to note, right? And now we can clearly see we are not in a consolidation. For an instance or something that can help you understand this sentiment is the EMAs. So not for trading, okay? I'm not a fan of trading EMAs. I'm more a fan of understanding the real logic of EMAs. It helps you pretty much to understand where is the momentum heading and what is price actually doing. And you can see in a consolidation, we are just driving through price. So price is just driving through the EMAs. This is a clear sign of a consolidation. What do we have right now? We had a small consolidation, so to speak. But overall, this is just a bearish price trend, right? It's just going short. And this is the core value of the EMAs to understanding. We cannot use this type of analysis in the CUT data. We have to use the hedging once again. And what can we see right now, besides all the news, besides the FOMC decision making and stuff like that? We had a small sharp drop here. You can see heavy bearishness, and then the market just rapidly declined. But what can you see overall? You can see since this point in time, we just had bullish hedging. Okay, we just had bullish hedging, which is now seeming to change. It's not guaranteed that it's going to change, and this is where people mess it up all the time and just want the holy grail. So when can I sell, buy, etc.? No, this is not how things work. It's just not, the purpose of that is not this. It's understanding how the context is formed for the future. Okay, so what I would like to see here, if we approach this area here and change this bullish behavior, because now we are not truly changing the behavior, it's like literally some points before we truly change the behavior, but right now it's still in a slight buying behavior with a bearish leg. If we do this once again and we go higher, the short trend will continue. And this is the hedging logic. If we now see just buying in the DXY, this trend will continue. And as soon as we see a change, just like here on the left, if we see something like this once again, then we will get the longs. So longs are basically being formed all the time. I can promise you the dollar will have a bullish rally. Maybe not this year, maybe next year. But it doesn't matter to me, because as long as this hedging behavior is not changed, I know for a fact that I can look for swing trading short opportunities. And this is the biggest value that you can have, right? You just know what will happen. You will time entries wrong. You will have many losses maybe. But this is something that doesn't matter if you can say in the future there will be a guarantee this and that will happen. You have more information than 99% of people. Okay, so what is my game plan on the DXY? I want to see if we change here. I know, okay, the CUT hedging behavior is now shifted and the bullish price leg can play out. With all the Fed news coming on and the potential new Fed chair that is being said, he wants to reduce the interest rate even further, you can expect a weaker dollar. Okay, low interest rates, dollar will drop. Well, that's interesting. So I'm guessing right now, and this is just a guess, but this is a calculated guess based on what is being said in the news, and this is still not priced in because we don't know who's going to be the next Fed chair, so to speak. So if we get this new Fed chair that is actually going to decrease the interest rates, then you will see a further dollar drop. This behavior here will be bullish once again because they are hedging against the short risk exposure. And as soon as I see this again shifting bearish, then I can promise you one thing: the dollar will rise and shine like it never has. I know that's a joke, but it will just begin to actually move price again up. Okay, but for now you are not good, or it's not advised in my point of view to actually look for longs in the dollar. So where is the value in that? Because now we just know what the dollar is doing. And you might ask, okay, how can I trade it? How can I capitalize on that? It's pretty simple. If you know the dollar buyers are more likely to be bearish till the new Fed check comes, so this is something you have to look out and just analyze this data. Just wait for that scenario or the break below this line here. So what can I do with this information? As I know the dollar, okay, I'm primarily bearish. Okay, what can I do? If you understand this logic, you know, okay, a weak dollar often means a good and rising stock market. So you can look for opportunities in the index or in some single big US tech stocks like Tesla or whatsoever, Meta, Google, Alphabet, whatever you want to like. But the most valuable information, because here you do need a whole different part of analysis. You can't just go long in Meta with a weak dollar. It makes zero sense, okay? But you have a very valuable information for the currency, for the forex market, okay? Because now you know that the predominant buyers in the weekly and monthly are going to be bullish or bearish, which gives you then value for your lower time frame trading and can enhance that trading and be a small part in your analysis that leads to more profitability, right? If you just can cut some losses out, it will help you. It won't help you if you trade the 1 or 5 minute chart. It won't help you at all. But if you're a swing trader, I think this is what can actually make a big difference. So for me it does, but maybe for you not. But you have to test it out for yourself. So I can just know on what these charts are going to do because they're all correlating with the dollar. I myself trade the futures market directly, so I'm just looking at the pound future, but you can just trade the JBP USD and you do have some sort of more bullish bias here, right? If you know the DXY is more likely to decrease, you don't want to position yourself here and say, I want to short the pound all the way down here. It makes, at this point in time, makes 0 sense, right? And then you have to complement this with everything else you analyze, but it's just a small part, and this is just a small video to explain to you why sentiment can actually change your trading game for the better, okay? In the next videos, I will dive more into how I actually swing trade, how I use volume analysis and the seasonality. I built some tools here and there, and I will give you these tools for free that you can also analyze seasonality. And I think swing trading is one of the only ways to become long-term profitable. Maybe you have a good run with scalping and here and there and this and that. But overall, investing, right, in stocks and value investing or deepening your knowledge in these areas is the way more better way to make actual money, right? The rest, you can be good intraday trader, but I don't think you can do this in the most liquid markets of the world. There is still an edge to be found, but it's more likely to be found in smaller cap stocks where there is a certain pattern that institutions can't trade because of their huge amounts of fucking money. It makes no sense for them. But overall, this is what I want to say to this video for the sentiment data. I hope you liked this insight, and I see you in the next one.